extend my warm-hearted thanks to all of you joining us tonight in New York. I'm your Master of Ceremony, Mark Kim, the President of Korea Finance Society. Now we will begin the New York Global Financial Leaders Forum. Our event is about to commence, and we are honored to have with us Mr. Chang Sung-jun, the Vice Chairman of Maegyeong Media Group, who will be delivering the opening speech. We kindly request you to give him a warm round of applause as he takes the stage.
Good evening, ladies and gentlemen. It is my pleasure and privilege to welcome you to the 2023 Global Financial Leaders Forum in New York. I would like to express my sincere gratitude to co-chairman Mike Ju and Sander Ho of Korea Finance Society, President Thomas Byrne of Korea Society, and Chairman Taehyun Kim of National Pension Service for co-hosting this event with Maegyeong Media Group. I would like to thank our distinguished speakers for sharing their knowledge with us tonight. The speakers are Stephen A. Schwarzman, Chairman of Blackstone, Alex G., America's co-head of private credit of Goldman Sachs Asset Management, Thibault Gournay, co-CIO of Anchorage Capital Group, and Young-Woo Ha, Chairman of Blackstone Korea. I would also like to appreciate the presence of Korea's top financial leaders here. They are Lee Won-duk, CEO of Uri Bank, Eun Gi-jo, Vice Chairman of Mirae Asset Securities, Jung-lim Park, CEO of KB Securities, Sang-tae Kim, CEO of Shinhan Securities, Dong-sun Lim, CEO of NH Amundi Asset Management, Ji-wook Kim, CEO of Shinhan Risk Management, and Jong-seung Lee, Executive Vice President of Hana Securities. My gratitude also goes to Chang-won Ho, CEO of Korea Insurance Development Institute, Yoon-bum Choi, Chairman of Korea Zinc Company, and Dong-seok Shin, CEO of Hunit Technologies. The last person to thank is New York City Mayor Eric Adams. He will arrive at the end of the forum, so I would appreciate a big welcome to the mayor. The Global Financial Leaders Forum began in 2010 with a purpose to expand Korean financial network globally. I believe this forum is an excellent platform for Korean and US financial leaders to get together and exchange various opinions and ideas of mutual interest. The forum will be held once more in October this year. There has been a lot of uncertainty in the global economy lately. On March 10th, the bankruptcy of Silicon Valley Bank sent ripples through the US financial markets. Recently, OPEC Plus's decision to cut production has raised fears of a global slowdown. Rising oil prices will also deepen the concerns of central banks as they can increase inflation. In this case, central banks will be forced to tighten again to fight against inflation. The geopolitical situation is also unstable. The semiconductor war between the US and China is heating up. The war in Russia and Ukraine shows no signs of ending. At the same time, finance is changing rapidly. Digital banks offer competitive advantages over traditional banks in terms of efficiency, productivity, and cost. and they are expanding their customer base by targeting young customers and people with lack of access to the bank. Although it took a downturn last year, interest in cryptocurrencies remains high. As uncertainties grow, I believe there should be more open discussion. This event brings together leading figures from the finance community to discuss essential trends in today's finance landscape and exchange insights on new pathways for investment. I hope this forum will serve as an excellent platform for participants from New York and Seoul to exchange innovative thoughts and opinions. Today, we are greatly honored to have distinguished speakers from Korea and United States. I would like to especially thank many VIPs from Korea who have made a long journey to New York to attend this forum. Once again, welcome to the forum, and I wish you the very best and success in all your future endeavors. Thank you.
Thank you, Mr. Chang Sung-jun. It is now our pleasure to introduce the esteemed President and CEO of the Korea Society, Mr. Thomas Byrne, who will deliver the opening speech. Please join us in giving a warm round of applause and a cordial welcome to the stage.
Well, good evening, ladies and gentlemen. The Korea Society is delighted again to participate in the Global Financial Leaders Forum here in New York City. This year marks the 70th anniversary of the US-ROK Alliance. Since 1957, when the Korea Society was established by General James A. Van Fleet, our mission has been to strengthen ties between Korea and the United States. So tonight, we're glad to contribute to the strengthening of the financial relationship between the U.S. and Korea. It's an honor to work with Mr. Sung-jun Chung, Vice Chairman of Make Young Media Group, Mr. Sando Hao, Co-Chairman of Korea Finance Society, and the Korea Investment Corporation in hosting tonight's forum. I would also like to thank our sponsors, the National Pension Service, Shinhan Financial Group, KB Financial Group, Udi Financial Group, and Hana Financial Group. It seems since the pandemic, world events have become more perilous in geopolitics, in finance, and also in economics. So, without listing the litany of challenges that Co-Chairman Chang already said, tonight I'm looking forward to hearing from Mr. Stephen Schwarzman, Chairman, CEO, and co-founder of Blackstone, in the session moderated by Mr. Young-Gu Ha, Chairman of Blackstone Korea. I'm also looking forward to hearing and listening to the observations from Mr. Alex Chi, America's co-head of private credit at Goldman Sachs Asset Management, and Mr. Thibault Gournay, co-CIO of Anchorage Capital, in the session moderated by Mr. Sando Hao. I would like to make special acknowledgments to Mr. Tae-hyun Kim, Chairman and CEO of the National Pension Service, for joining us this evening. And of course, I welcome and look forward to the Honorable Eric Adams, the 110th Mayor of New York City, as our special guest tonight. Thank you.
Thank you, Thomas Byrne. We will now commence a talk on navigating challenges.
Okay, good evening, ladies and gentlemen. We are very honored tonight to have CEO and co-founder of Blackstone, the largest leading global asset management company with nearly $1 trillion asset under management. He founded Blackstone with Pete Peterson in 1985. He joined Lehman Brothers in 1972 after graduating Harvard Business School and became youngest partner ever in Lehman in 1981. And 1983, he sold Lehman to American Express. Before Harvard, he graduated from Yale. He is active philanthropist with a history of supporting education as well as culture and the art. In 2020, he signed Giving Pledge, committing to giving the majority of his wealth to philanthropic purposes. He established Schwarzman School of Computing in MIT and Schwarzman Center at Yale, Schwarzman Scholars in Tsinghua University in China, and he donated the largest amount, single amount, to Oxford University. And also he served as chairman of the Kennedy Center for the Performing Art. Not comprehensive enough to introduce Steve, but I'd like to stop here. Is it okay?
I think that's enough.
All right. To kick off the fireside chat with Steve, please welcome Steve with a big hand. Steve, would you give us a few words as an opening before asking tough question to you?
Yeah, sure. It's great to be here, and it's wonderful that so many people came from Korea to New York. As the speaker said, this is a complicated time in the economy globally, in Korea, in the United States, all around the world. I'll answer a question you're going to ask me about what's happening.
All right. Can I start?
Go for it.
All right. I prepared the tough questions, but I'd like to start with the easy one. Last month, 3 U.S. banks, SVB, Signature Bank, and First Republic Bank failed, and Credit Suisse forced to sell. And there's a lot of uncertainties in the market and the economy. What are you seeing on the ground in terms of economy in relation to the rate hike and central bank's position? And how do you expect this unfold in the next 1 or 2 years?
Yeah, well, on the ground, surprisingly, the economy is doing quite well. In the United States, it's doing pretty well in Europe, and except for interest-sensitive kinds of industries. So, for example, real estate construction is getting hit very hard just because of higher rates. But things that aren't directly influenced by higher rates are doing nicely. And the reason for that is that during the pandemic, everyone who worked from home did not spend much money on these types of clothes. They didn't go out of their house that much because so many things were closed. So they didn't spend money going to movies. They didn't go to restaurants. They didn't get on airplanes. They didn't travel anywhere. Even in a car, there was almost no place to go. And so people who were employed had much higher after-tax income. all over the world. And that money, basically, I estimate, increased people's income by at least 30% because they weren't spending the money. And that money after the pandemic was very large. In the United States, there was over $3 trillion. And that money was spent when the pandemic was over, and there weren't enough goods at that time, just because the supply chains were not sufficient. And so there was a bidding frenzy to buy things because people were so happy after the pandemic. That amount of money is still being spent. And that's what's keeping the economy in the United States and in Europe growing faster than any of the economists would have predicted.
Okay, then since you starting Blackstone, you have experienced many cycles and many crises, but you successfully navigated through all those cycles and crises. Given your experience in the investment space across many cycles, how do you put some of current challenges into context?
Yeah, well, the challenges now aren't that compared to many of the other cycles. And 1982, which was a terrible recession in the United States, we had interest rates in this country that were very high. And just as an example, I was involved issuing a bond, 10-year bond for an A-rated credit called RCA Corporation. The interest rate was 16%. So when we talk about interest rates being so high now, you know, you have a long bond of 10-year bond now is what, 360 or something? 16% for a corporation. So if you want to know what inflation was like, this is not much inflation on a relative basis. And the global financial crisis, where financial institutions really were in danger of failing, and the system could have gone into a depression without some very expert types of work done by the US government, which then helped other governments around the world. And that was a real crisis. What's going on now is not a crisis in a conventional sense. The banks after the global financial crisis increased their capital at least 3 times in the United States, sometimes 4 times. So there should be no problem at all. But why is there a problem? There's a problem only because the large amount of deposits that went into the banking system as a result of the savings I talked about earlier gave those banks only 2 choices of where to put the money. They either made loans, the economy wasn't growing fast enough compared to the savings, the money that governments were giving everybody. Right. So if you couldn't put it into loans, you had to put it into securities. So what happened is bankers tended to put it in the safest securities, which were US government bonds. Right. And in order to get the biggest spread for what they had to pay for deposits, they went out farther in terms of maturity, so they bought 10-year bonds. So maybe the yield on that was 1.5%.
SBB.
1.25%. But then to cure the inflation that came after the pandemic, the central banks in the United States, Korea, ECB, everywhere, raised interest rates. So what you owned with a 1.25% yield, that new bond went as high as 4.23. So that meant the old bonds went down in value. That decline in value, if you marked those assets to market, crushed the equity. Certain banks, not all banks, had this problem. So the faster the bank was growing, more deposits people gave them, the bigger the loss would be.
Yes.
But it was a temporary loss. It wasn't a credit loss, because when interest rates go down, those bonds will go up again.
Right.
But at the moment, they're still pretty high. And so what happened is that certain analysts looked at those banks where the equity went down and said, I think there's a problem. And what they did, and this is very interesting for those of you who are financial historians, in the old days, to get your money, you actually went to the bank. If you were worried about it, filled out a little deposit slip or withdrawal, and they gave you your money. What happened after the global financial crisis is that Apple invented the iPhone, and now Samsung has a huge iPhone business. Instead of going to the bank, you can watch television
Anytime, any place.
anytime, any place, do anything. You can take all your money out of a bank. No one who was a regulator understood the impact of this technology and the ability of everyone to move their money around. So what happened in this, quote, crisis is that a few banks were caught in this position, and people started moving their money out. And in 3 hours, $40 billion moved out Silicon Valley Bank, and the bank collapsed. And so this is a very non-traditional problem. Usually, banks get in trouble because they have bad loans, not because they own treasury bonds of a country that's a good country. It's sort of an odd crisis, and that's because deposits are not fully guaranteed in the United States or Korea. And people got worried if a bank got in trouble, they'd lose their money because it wasn't guaranteed if something went wrong with the bank, and they started just moving all their money around. That's why you have an issue. That issue is a relatively short-term issue. It's restricted to a certain number of banks.
Right.
When I started in 1972, there were over 12,000 banks in the United States. Now, there are 4,000 banks.
Yeah.
So something happened to all of these banks. It's normal for banks in my lifetime to disappear, either through mergers or because they have some difficulty.
Okay.
So that's a longer answer than you wanted. That's what's going on.
All right. Actually, market is paying attention to inflation and business activities. And as Blackstone has many portfolio companies in different industries, so you might have a very strong and direct feels about what's going on.
Yep.
So can you share?
Yeah, and the companies are doing quite well, except, if you have something that's involved with housing or certain types of real estate, those businesses are affected. But, for our companies, we're announcing our earnings on Thursday, so my lawyer would want me to be careful of what I'm saying, but they're holding up quite well, as is most of the U.S. economy.
Okay. All right. What basic lessons do you apply when investing during this period of adversity?
Yeah. Well, I have a simple rule, which is don't lose money. I've never seen a money manager be popular by losing someone's money. And on our third investment at Blackstone, probably 1988, we lost money, and it was my mistake. And I was extremely embarrassed about it. And I decided that should never happen again. I realize this is very simple thinking, but it's good thinking. And so whether it's in this time period where there's more uncertainty or other time periods, the first thing you have to do is always make sure that you sort of stress test any investment that you make so that in no vaguely reasonable scenario could that investment lose money. And if you start from that basis, that almost everything you do makes money, the only question is how much money.
That's right.
And you'll end up with a very good result as we had. Investing in this time frame, there are going to be some very interesting things because interest rates are so high relative to where they were that private debt and credit is a terrific investment. So you could make 10 to 12% with senior secured debt. So I started my career buying equities at the bottom of leverage capital structures. If you could make 11, 12% return all the way at the top of a capital structure, that's such a good return for almost no risk that asset class, which was out of favor for probably 7 to 8 years after the global financial crisis, is now an easy place to be. Things where technology is working, like data centers, with ChatGPT and all of these AI new technologies are going to demand enormous amount of what they call compute power. And to make that work, you have to have data centers. So the return on those are going up, and when you are in that business, you don't build those on speculation. Somebody wants them. One of the big sort of hyperscalers, whether it's Microsoft or Google or AWS, and that's a good business. Investing in things involving travel and experiences is another area I mean, it's hard to get an airplane reservation in a lot of countries. And even in resort hotels, which is another interesting area.
Price has gone up a lot. Airfare.
The prices
Hotel.
of all these things have gone up. So if you happen to own things like we do, you know, at Blackstone, you know, we've got about 250 companies that we control and more that we invest in. We have 750,000 employees, which isn't big in Korea. But it's big in the United States. It's 750,000 people. And so, you know, we can see where demand is. And, you know, in the resort hotels, right after the crisis, you could charge almost anything. People just wanted to be someplace other than their apartment or their home. So I can go on for a long time, but then no one can ask any other questions. So we can get to the next question.
Right. On behalf of our the participant, I'd like to ask one last question. Where they should put the money as an investment?
You should give it to Blackstone.
And that's it.
No. There are a lot of places that I just went over, whether it's in private debt, whether it's investing in infrastructure, which is very secure, you know, where our returns in that area are like between 15 and 18%. That's a good place to put money. Buying warehouses and real estate in the United States and Europe and actually around the world is a fantastic place to put money. So there are a lot of interesting places.
All right. Because of the time limitation, then I'll have to stop here, and then I'd like to invite a question from the followers. So please raise hand who have a question to Steve. Please. His name and company, people.
Youngjun Kim, I'm a retired partner from law firm Millbank. I know most of the audience is interested in making money, but I'd like to ask a question about the opposite. As a fellow Yale, I appreciate your effort at the Schwarzman Center. How do you personally balance between managing this gigantic enterprise with Blackstone and also huge philanthropic efforts? Because the latter is also as difficult in many ways, and you're also investing in the future for the public good. So I'm sure a lot of thoughts go into how do you balance those two?
Balancing. Well, I don't sleep much. That's the best way to balance things because, you know, in a way, in an active life, which I have, I don't like to give up anything. So I keep adding on and sleeping less. The way I trade things off is I'm very fortunate now at this stage of my career that I have a partner named John Gray, who's president of the firm. You know, I'm the chairman and CEO, but John's now doing all the things that I used to do, the way you do when you start something. It's always good to have somebody else, you know, who's at least as good as I am. Actually, John's better. And so that frees me up to basically, at the firm, you know, troubleshoot. And when you have a large group of assets, it's one of the largest in the world, there's always something going on. But you do have a partner, you know, for day-to-day stuff. So the firm is endlessly interesting. A great place to learn what's happening in the world. We have a unique position. In philanthropy, I've always taken the position that at least to myself, it's a bid, like starting another new business at Blackstone. And I like starting new things. I just don't like to give money to people who ask for it. It's not solving something that interests me. So I like to take a problem that I see and say, can I make some very substantial difference to solving that problem? And if I do, I'll come up with an idea, and I hope that someone else will put up the money. But they never do, since it's my idea. So I get stuck, putting up the money. So I'll give you an example or two. I was interested in U.S. competitiveness in artificial intelligence because I was on all things a bus with Jack Ma in Beijing, and I'm not a technology person. I'm like a generalist, and he was talking about artificial intelligence. It was probably 7 or 8 years ago. I'd never heard of artificial intelligence, and he was explaining it was going to be a really big thing. Some people would think it was great. Some people would think it was dangerous. And so we spent like an hour and a half learning about this. And a friend of mine who was head of MIT, which is regarded as the #1 technology university in the United States. And I was just mentioning to him, I'd come back from China, and people were talking about AI, and where do we stand in the United States? And he said, well, we should be doing better. We invented AI, and we didn't have enough teachers to teach AI, and he said we need more computer time. Variety of other things. And I said, well, what's your dream? And he said, well, if I can double my computer science department and be the first university in the world to use artificial intelligence in every part of the university, that's my dream. And I said, well, it sounds like a good dream. So if you have the biggest computer science department in the world, then your competitors won't like it. At Stanford, or Berkeley, or Carnegie Mellon, it seems to me that if you do that, they have to do that. That will make the U.S. more competitive. And he said, yes, that's exactly what will happen. So I said, well, how much would it cost you to do that? So he said, I don't know. It's a dream. I said, well, why don't you price it? Never say that.
Unlimited.
To any academic president. So 3 weeks he comes back and he says it's $1.1 billion. So, and then he said, why don't you give me 1.1 billion? So I told him to go away. Good luck. He said, well, maybe you can give me half. I said, who do you think I am? I'm just a hardworking person. So finally he got $350 million out of me. So because I didn't know how good this idea was, I said, I will give you $350 if your board of trustees and speaks for $350 million. Because if you don't want to put up any money, that means it's not a good idea. So in 3 weeks, they put up 350. So then we had 700, so we could start. So that became the new MIT Schwarzman College of Computing, and the other universities very quickly started doing something else. And there still wasn't enough capability, so we needed the US government to put up more money for the development of AI. That took a few years, and that's what we call the new CHIPS bill that was passed. So this whole program started from nothing, and now it's a famous thing. And that's how I get involved with philanthropy. I don't even view it as philanthropy in a normal sense. And every project I do has some kind of element where I'm trying to make the world either a better place or a safer place or something that touches a big theme. And usually that involves starting something. Because if you don't do that, the existing world hasn't taken care of that problem. So I like looking for things like that, and they tend to find me, which is dangerous. So that's how I balance.
All right. Having a great dream and realize it is the way to balance your life.
Yes, because what happens when you pursue a great dream, and you know you can make like a huge difference, it's not like work. It's like a joy. It's a mission. And everybody in life likes to have some mission that's important to them. And I'm very good on these temporary missions. You know, fix that up, go back to my regular life, and then something else usually ends up happening. And I usually do one at a time, these big ones, because I still have a job, and I still have a family. So there's only so much you can do.
Do we have just time to get one more question? Is it okay? Yes. All right. Anybody who has a question? Over there.
Thank you so much for speaking to us today. My name is Angie Bian, and I have my own international global consultancy. And in 2019, and prior to that, I was doing a lot of business in China and elsewhere in APAC. And I just wanted, you mentioned Jack Ma and your meeting in Beijing, and I wanted to get your thoughts on your businesses in China, and also, you know, in light of what's happening geopolitically, if your business has cooled with, you know, businesses out there, and wanted to get your sense of your investments out there.
Yeah, I didn't get the whole question because there's a little reverberation. It was a China-basic question, and clearly the two biggest countries in the world are having difficulties in their relationship with each other, and that's not a a good position for either of those two countries, in my view, or the rest of the world. The U.S. and China together are roughly 40% of the world's economy, maybe 42%. So there are over 200 countries in the world, and two of them are going to close into being close to half of the world's economy. And so it's really essential that those two countries develop, a working relationship that's functional for both of them. And that's the challenge, I think. geopolitically for the world. And that's a little above my pay grade. I'm not a government official. I'm just like another person in the audience. And I could tell you what my hopes are, because now that relationship is not on a good course.
Maybe Koreans in this floor might have a question, and how Korea should do in between China and U.S. That is the complicated geopolitical situation. Any recommendation to Korea?
Yes. Move carefully.
All right. Thank you, Steve. And then I'd like to close the session with a big hand to Steve. Thank you.
All right. Can everybody hear me? Okay, my mic's working now. So it says, downside protected investing in times of macro uncertainty. I think that means don't lose money and try to make some more money than a treasury bond. And I think Steve Schwarzman said it very well in terms of pumping up the value of credit investing. By the way, I want to congratulate you on getting the spot to speak right after Steve Schwarzman, and before the mayor comes in and before dinner. So low expectations. Good luck with that.
Thanks for having me.
It's all about the moderator. All right. Let me introduce the two of you really quickly, and then we'll just get right into it. So Thibault Gournay grew up in France, and he went to Brown University. He worked at Goldman Sachs right after college. He has been working in distressed and credit investing for over about 23 years now. He was at a hedge fund, Grey Wolf Capital, before joining Anchorage in around 2008, and has been there for the last 15 years, building out one of the top premier credit investment funds in the world. They currently manage $27 billion plus, and Thibault is the co-CIO. On a personal note, he is married to, I believe, a woman of South Asian descent, and so he's part of the greater Asian family and the greater Korean family, so we embrace him as one of our own, as part Korean American. Thank you, Thibault. Alex grew up in New York City. He graduated from MIT and started working at Goldman Sachs in 1994. He still works at Goldman Sachs in 2023. He has been there for 29 years, going on 30 years. He has had an amazing career there. He currently manages the Americas private credit business, and he is an absolute Korean American legend. Even though he looks like he's a 30-year-old Filipino. His 50th birthday. He's 50 years old. He sings like Elvis. He invests like Steve Schwarzman. He has the whole package, and he inspires a whole community. So thank you, Alex. Thank you to you both. So let's just get right into it. Could you start out Thibault, you want to start? Do you want to just give an overview of your investing platform?
Sure. So Anchorage, as Sandor says, has been around for 20 years now, and we are specifically focused on tradable credit. What that means is, take away the investment grade market where little tends to happen in normal times. We are focused on the high yield market and the leveraged loan market in the US and in Europe. And those markets have grown significantly over the past decade. US high yield and leveraged loans today is about 2.8 trillion. Europe is about 700 billion. So big markets. We have stayed within that tradable universe and not gone in direct lending in assets, because frankly, we believe that the bigger platforms like the Blackstones, like the Goldman Sachs, have a structural advantage when it comes to sourcing and originating that type of risk. We try to build and evolve a platform to give ourselves a right to win in tradable credit. And what does that mean? It means having the ability to do that entire credit spectrum, right? Starting with WB credit all the way to distressed. You need different fund structures for that. And so of the 27 billion in assets, 20 billion of that is really CLOs and CDOs. Those structures allow us to buy single B credit, double B credit, relatively safe credit, and all the way down to distressed. So we have, on top of the 20 billion in management in the CLOs, we have about 5 billion in opportunistic credit funds, drawdown style, private equity style. You need to have both in order to follow this market well. 2.8 trillion of US leveraged loans and high yield is across 1,400 names. So the average capital structure is $2 billion, 1,400 names. If you're just a distressed manager, you have no ability to do the work on that many names. What we have is a single team of about 50 investment professionals that will underwrite every deal that comes to market in high yield, every deal that comes to market in leveraged loans, to see if they fit for our CLO CDOs. The hit rate in those vehicles tends to be 20-25%, but for every single name that comes to market, we will meet the company, we will build the model, we will go through the docs, and we build that portfolio of knowledge, that library of knowledge that then feeds into our activity on the stress and distress side. And that approach, having a single team as opposed to a separate CLO team and a separate special situations stress team, is pretty unique to us and gives us that continuity of coverage that you need when the volatility comes. What we found in tradable credit is it's very competitive at the larger liquid end. At the smaller end, in capital structures that are sub $1 billion, if you can address that market, you get much better risk reward, which is what we want to focus on.
Alex?
Great. Well, first of all, 여러분 안녕하십니까? It's a great pleasure to be here. Thanks for having me.
Is that it?
That's it. And many of you are also investors in our funds, such as KIC and NPS. Just want to say thank you for your partnership and trust in us. So at Goldman Sachs, one thing that people actually don't know is that we actually have been investing in alternatives for over 30 years. I think most people know of Goldman Sachs as an investment bank, as a mergers and acquisition specialist, as an IPO specialist, as well as a sales and trading house. But we've been investing in alternatives for a long time. We actually have a very large alternatives platform. It's about $500 billion in assets. And we have all kinds of assets from private credit to private equity, real estate, growth equity, infrastructure, you name it. And for us, private credit is the largest sleeve with about $100 billion of assets under management globally. And we invest across both senior credit and first lien, in junior debt, in structured equity, across both performing and opportunistic credit. And as Thibault mentioned, it's important to have a diversified source of funding. So we have traditional private equity style drawdown funds where we raise capital from institutional investors. We also have publicly traded and private BDCs where we raise money from retail investors. We also invest off the Goldman Sachs balance sheet, and we have a diverse array of managed accounts from large investors as well. We have about 185 people dedicated to investing in private credit globally, and we have over 600 portfolio companies in private credit, which gives us a good lens into what's going on in the macroeconomy.
Great. So we've got two experts in credit who have been doing it for a long time. Why don't we just get to what's your investment outlook? What should we be doing? What are good ideas? What are your teams focused on? What are your teams concerned about?
Sure, I'll go first. So, look, as Steve Schwarzman mentioned, we are certainly living in a very uncertain time. For the past year, the big focus was on inflation. And we saw what the Fed did with its aggressive rate hiking policy. And I think we're now starting to see some impact from that. Although the monthly CPI increases are still high, they're starting to come down a bit, still a bit too high for the Fed. And with respect to jobless claims, they're starting now to see some higher numbers. And so there's some impact, but still obviously very focused on inflation. And we're still seeing it in our portfolio companies on the cost side. So now people are now starting to focus on other risks, such as real recession risk. Obviously, what happened with respect to, we talked about Silicon Valley Bank and some of the other regional banks, and the likely regulation that's going to come along with that. I think that's going to further tighten credit for the economy, and that's going to have an impact. At the same time, there's a big focus on commercial real estate. And we're just seeing some statistics, and I think that goes along with the regional banks. I think the regional banking sector is responsible for about 65% of the lending to the commercial real estate sector, so that's going to tighten. Some other statistics are about 30% of commercial real estate office space in the metropolitan areas is considered redundant, and only about 15% of commercial real estate can actually be repurposed into other facilities such as restaurants or hotels. So there's going to be a shakeout. So that's creating a lot of macroeconomic uncertainty, and that's creating a muted environment with respect to mergers and acquisitions and capital markets activity, which then has a follow-on effect on investment opportunities. So it's an uncertain environment, and so therefore we're being very careful and very selective about the companies that we invest in.
Yeah, would echo the most of that. I mean, the fact is we're in this part of the cycle where there is a lot of uncertainty. There's a very wide range of outcome, and so as investors, it's downside protection first. You know, specifically for us in distressed credit, it's very early days, right? Defaults are still sub 2%. Average of the past 20 years is closer to 4%. So, and what you've seen is really it's a question of maturity walls or really not getting going until late 24, 2025, 2026. Reason that is the capital markets were wide open for all these companies really through 2021. So if you were a CFO in 2021 with low rates in a white hot primary market, you know, your responsibility was to roll forward your maturity wall into lengthen out your runway, which they all did. And so we're right now in this phase where in tradable credit, and Mr. Schwarzman talked about it, there is an opportunity to make top of the capital structure double-digit returns. That is the first time we see that in 15 years, outside of a couple of dislocations around COVID, around the 2016 energy crisis. At the same time, it is very clear to everyone that default rates will go up materially in the next couple of years. So what you want to do is stay defensive, look for either uncorrelated risk or industries that are very defensive and will do okay even if the recessions that will come inevitably in the U.S. and in Europe end up being, relatively deep. We're not macroeconomists, but we have to respect that range of outcome. And what we are very convicted about is it is early days. Default rates will rise, especially when you think about the size of the tradable market and how much of it is low quality. One of the things that's very different about this market now and the market 10 years ago is the percentage of triple C and single B minus risk that makes up that leveraged loan and high yield universe. It's about 25% over high yield and leveraged loans. If you think about that market, triple Cs today are trading at 15% yield. Now, triple Cs, the average of the past 20 years is 25% of them do default on a regular year. So it's all about your selection, all about mining your industries for the right names, staying defensive, and hitting singles until it is more time to play full on distress and to buy businesses through the day.
Thank you. And I'm going to add that I have moderator liberty to mention as well. I think it's the most attractive time ever to invest in U.S. middle market credit, invest specifically in first lien loans, make 15% in companies that are good companies that might make $50 to $150 million in EBITDA you've never heard of, but the end market is there and it's going to grow, and you have some real protections, and you have a real coupon, and you can generate outsized returns versus equity markets, high yield bonds, and other things. Sorry to add some commentary.
I agree.
So we all agree. Chairman Schwarzman agrees too. The reality is that so many of the Korean institutions in here are very involved in U.S. private credit, are very much taking advantage, and are highly respectable scale investors. I actually think Korean investors can take advantage more. For folks like Anchorage and Goldman Sachs.
Yeah.
So what are you guys most concerned about? So we have this opportunity to make whatever it is, 10 to 20%, could be more attractive than equities, public equities, who knows where it goes. There's a lot of other, more risky assets out there. And as Chairman Schwarzman mentions, historically, that's a pretty darn good investment. What are you guys most concerned about?
So I agree with you. Right now, it is the most attractive time to be a private credit investor, to make unlevered returns of 12 to 14% at the top of the capital structure with equity, massive equity checks that are beneath you. That's right now. At the same time, private credit has been around for a long time. And there are a large number of companies that borrowed 18 to 24 months ago from private credit when base rates were at 25 to 50 basis points. So let me just some simple math. So 18 months ago, you have a very stable software company that's got about $100 million of EBITDA, cash flow. They borrow 7 times leverage, which at the time was right down the middle of the fairway. So that's about $700 million of debt, and that's cost you about 6% at the time. So it's $42 million of interest expense. So you have $58 million where you can invest in, you have to pay your taxes, you have to maintain your business with a minimum amount of CapEx, you have to pay for working capital. It's all your typical fixed charges. Now, just 12 months later, base rates are close to 5%. So now that same amount of debt, it now costs you 11%. So now it costs you $77 million a year. And now you only have $23 million left over. And so at the same time, because of the economy, your revenues aren't growing as quickly. You have all this inflation, so your costs are going up. You can only pass so much of that along to your customers, so your margins are getting squeezed. So at some point, you're going to run out of liquidity. And I think to Thibault's point, and we're starting to see that with a number of our portfolio companies, if you have not hedged your interest rate, you're going to hit this liquidity wall, and God forbid you have maturity that's coming up. So I think because of that, you're going to start to see default rates go up. So that worries me, number one. Number two is because software is such a sticky, recurring business, private credit loves to lend to software businesses. So if you look at across the portfolios of all these direct lenders, you'll see software and you'll see healthcare. But if you break down healthcare, a big portion of that is healthcare IT, that's software. So as we've now started to see, there are more and more cyber attacks that are happening. So to the extent that there's a big cyber attack on the software industry, I think for private credit and just in general, I think that's a big risk that I think people really haven't paid as much attention to.
Got it. Understood. Thank you. Thibault, any thoughts on that?
Yeah, look, I would echo Alex's comment on the rates risk in tradable land. So he talked about it from a direct lending, private credit lens. In tradable lens, you look at the leveraged loan market specifically, right? And a lot of that is companies that do not hedge the rate risk. So if you think about the single B minus cohort, the analysis recently done by Morgan Stanley was showing that with EBITDA flat from 2021, and 2021 was more or less peak margins across the board, just a rate move takes about 40% of these companies to a place where fixed costs are above EBITDA, just a rate move. And so you're going to end up with a lot of companies that are not necessarily bad companies, where the asset value may be there, right? They may be, equity above and beyond the debt, but the inability to generate any levered cash flows therefore delever and have an easy, normal path to a refinancing, it's just not there. And we see a lot of those. It's meant, we call it stress credit, right? So you're looking at these leveraged loans in the 70, 75 cents on the dollar, and you look at it and it's probably covered by value at par. It's definitively covered by value at 72 cents, but with rates going up, these companies will not generate any cash. And so when the maturity does come in 2025, 2026, what happens is does the sponsor putting up cash in order to facilitate a normal refi? Do you take the keys? And for us, early doors in our funds, we want to really focus on that stress credit universe, pick the right single names before we get to the point in the cycle where we are comfortable enough with the outlook to really take companies through the debt. The other risk I would mention is docs. You have to mention it. The docs, the credit docs in the high yield and leveraged loans have gotten so much worse over the past 5 years. It's all cover light. It's a lot of room for the sponsors to do nasty things, and more these sponsors show the willingness to take advantage of the docs to either lengthen runway or capture discounts, and that's a big risk, specifically for smaller managers. So if you're a big enough manager to be on the steering committee to basically count for the 50% or 60%, whatever that threshold is, then you can protect yourself. If you're a small manager, it's a lonely place to be, and you're seeing more and more deals where the delta between steerco economics and everyone else's economics is massive. So I would mention that as a risk, and again, the way to protect yourself from that is invest with the bigger guys.
Thank you. And if I can add a comment, piecing both your comments together, is that when you do it the right way, like these folks are doing, and investing in credit, and you're investing at the top of the capital structure, if there's a default, it doesn't mean it's a bad business. So you can take something through restructuring where if it gets refinanced, if you get refinanced, you win. You get paid 100 cents on the dollar. If you get a restructure, you own the business, you might make a lot more money. Mm-hmm. It's the beauty of investing in the top of the capital structure. It's partly heads, I win, you repay me at par. Tails, you, unfortunately, the owner, lose, but I still win. Now, given everything we're talking about, if you can make 12 to 14%, you can make 12 to 20%, what do you think the room, or let's say Korean investors in general, the market in general, doesn't fully understand about credit? Or should I be allocating a lot more to credit? I'm just curious what you guys may think that the room doesn't fully understand, with all due respect to this awful room.
So I do think there will be a meaningful dispersion in performance between smaller managers and larger, best-in-class managers. The reason I say that is it is a more complex world out there. Even if the economy, our outlook for the economy, is very low growth, kind of sticky inflation, right? So not great for risk assets, but nothing, nothing disastrous. Even in that scenario, on an industry by industry basis, there is a lot of noise, there is a lot of disruption, and to the extent you are not equipped to deal with that level of complexity. I mean, as we talked about it with Sukim on the way up here. Sukim, my partner, manages all of our CLO research. It's gotten a lot more complicated to populate your CLOs with 150 names that you feel comfortable with. The reason folks like us can do it is because we will have a team of very experienced analysts covering the market sector by sector. They will have 20, 25 names that they own. They will have another 20 names that they follow. They will get KPIs and data on all those names in one single industry on a quarterly basis, and they will mine all that data to form a really nuanced industry view that then directs how we invest capital in that space. If you have that, and on top of that you have the restructuring legal capabilities to deal with a potential aggressive, discount capture by a sponsor or an amended extend discount. If you can marry all that in your platform, I think you'll do phenomenally well. To the extent you are, with some managers that are now subscale, having to cut costs to rationalize their business and end up, having one analyst covering 16 names, you're in serious trouble. The other risk that I would mention is Europe, in terms of restructuring, has its own risks. So you mentioned, Sandor, like we love to buy businesses through the debt when the time comes, right? When distress is cheap enough because default rates are high enough, and you're picking the right names, and you're comfortable enough with the outlook on the economy. We love that. That's what we've been doing for over 20 years. But you gotta underwrite the restructuring dynamics correctly, and you gotta price those correctly. In the U.S., Chapter 11 is relatively predictable. Sponsor behavior has become more challenging, but you can more or less underwrite how a simple capital structure, take like a unit tranche loan, right? Just will behave through a restructuring process. How much of your debt will be reinstated into an instrument that you can quickly monetize? How much of it will be equitized? You can underwrite all that. Europe is a collection of jurisdictions that are from pretty bad to terrible. And if you don't understand that, you cannot invest safely in distressed. We've been doing distress in Europe for over 50 years. It took some pain early doors. You got to get a few things wrong before you really understand what you're doing. You have to know the players not just the restructuring advisors, but the local administrators, the government-appointed administrator, to figure out how they work and what deal may or may not, be achievable in one situation. So that's another thing to look out for.
I think the Korean market is still on a journey understanding private credit. So I think Korean investors have a long understanding of public fixed income. It's liquid. Have a long understanding of private equity. Have invested in private equity funds for a long period of time. Private credit is still relatively new. And I think people are still figuring out what bucket to put it in. Do you put it into public fixed income? Not really, because it's not liquid. Do you put it in the same bucket as private equity, which is what a lot of investors did, but because it didn't generate the same level of returns, private equity often got ignored. But now I think people are now starting to understand what private credit is, right? It's a different asset class. If you compare it to public fixed income, a couple different things. One is versus the CLOs and mutual funds, where you have to make investment decisions based upon largely public information. Private credit, we conduct private equity style due diligence. We sign NDAs, we get confidential information, we work with the management teams, with the sponsors, we do a lot of research. And so if you look over time, if you look over the last 10 years, if you look at private credit returns and yields versus public credit, you have to get compensated for that illiquidity. And over time, no matter where you are, private credit has been able to generate 300 to 400 basis points of premium. And so as a result, for very safe risk, top of the capital structure, I think many pension funds and life insurance companies are now starting to understand the attractiveness of private credit. So I think there's a lot more room to invest.
Understood. We are in the middle of a crisis now. Having said that, credit markets partly bottomed in Q4. The markets are a bit more firm today. People always like to think about, well, where are we versus 2008 and how that crisis developed. Any thoughts around where we are in terms of the makings of this crisis or not a crisis, and in comparison to 2008 to 10?
I'm happy to go first.
Sure.
I think we're early. I mean, you look at U.S. high yield as the biggest benchmark. I think spreads today are 450 basis points. Average spread for U.S. high yield in non-recessionary period is about here. It's 450 to 500 basis points. So the high yield market is now pricing in a recession in the next couple of years. We think a recession is relatively likely. So it is early. And in terms of default rates, it is definitively early because of the dynamic that we talked about earlier in the maturity walls, meaning defaults are coming off the bottom, but still at like 1.5%. They will go, whether they went to 11% in the GFC, right? Last 12 months, default rates went to 11%. Will they go there? We're not sure, but will they go to 4 or 5% in the next couple of years? We definitively think so. Definitely so, given an outlook of low growth, relatively sticky inflation, and more importantly, low quality single B minus and triple C issuance. If you think about what got issued specifically in 2021, people were getting away with crazy EBITDA adjustments, right? The average EBITDA adjustments in 2021 was 25, 30%. The EBITDA was fake, right? So you're starting out marketing a deal saying, this is levered 5 times at peak margins in 2021 with peak adjustments. Reality is it's levered 8 times. And it might be a business that's worth 8 times or a bit more, but then when rates get going, you have a problem. So it's very early. It doesn't mean that you can't do well. In our private equity style fund, we like at this point in the cycle to build low duration, good IR, downside protected, top of the capital structure, low to mid teens, and then wait for a fatter pitch on the distress side.
I agree with all of that, and the only other thing I'd add is if you compare it to the GFC, I think the level of risk that is on bank balance sheets today is a lot more manageable than when we came out of the GFC. Today, if you look across the banking sector and you look at the number of hung loans that are out there, it depends on who you ask, but it's roughly around 40 billion or so. It's really well known. I think it's well understood, and I think it's a very manageable amount of risk.
Understood. Mark, Mr. MC, are we good on time, or should we go to questions, or should we stop? Or can we continue forever here?
I think we're still good on time, but the mayor is nearby, so we might have to
He has some thoughts on credit?
Yeah.
But I think we can keep going, Sandor.
Sure. Why don't we, are there any questions in the room? Yes.
There is a strong interest in private credit, but Mr. says that how the Korean investors are still interested. And I want to ask a question about the commercial real estate loan. And I understand that a huge amount of loans, 2 trillion or even more, is that amount is going to mature for refinancing in a year or so. So how would that play out? I understand that will create some buy opportunity, but there'll be default or credit loss.
Yeah, I'm happy to take that. It's the commercial real estate portion of high yield is not that big. I know that in Europe, between investment grade and high yield, it's about 250 billion of real estate, commercial real estate related credit. Most of that is in IG. I think high yield, the number is maybe 70 something like that. Meaningful, but not massive. Now the question is how much of that gets almost downgraded from IG to high yield. How much pressure does that put on high yield funds? It's actually interesting. You mentioned that a lot of the early defaults that we're seeing in Europe are related to commercial real estate. They're not necessarily bad businesses, but they are companies that have massively over-levered themselves to make acquisitions and grow at the wrong time and not cannot sustain their cap stack. From the distress standpoint, it's actually an opportunity if you can single out defensive real estate. I'll give you an example. One of the earliest defaults in this cycle, late last year, was a German company that owns regulated housing, basically low-income housing, on which you cannot increase the rent by a certain amount every year. It's a 98% occupancy asset. There is absolutely nothing wrong with it. It's not like office space where you're wondering how many people are coming back to the office. This is very safe. But cap rates are going up. They're going up because rates in Europe have gone up so much. And so this company that over-levered themselves, was unable to actually roll their maturities and filed. For us, that's an interesting early cycle investment into an asset that we know is very defensive. The cash flows won't budge. And we can create, that real estate at a very attractive cap rate, around 6% versus, historically kind of 3.5%. But so I think you'll see things on the commercial real estate. I do think that a fair bit of it sits in the U.S. regional banks' balance sheets. That is definitely worrying people in terms of, potential holes. And I mean, they're well-capitalized banks, but potential issues. I don't think that necessarily makes its way to our universe, to be honest. But something to look out for.
Got it. Any other?
We're getting the yank.
Sandor, sorry, I think that's the last question. So any quick thoughts from either Alex or yourself as you wrap it up?
I appreciate your interest in private credit. Again, appreciate your partnership, and if you have any questions, please reach out to us.
Thanks for having us.
I would just add that both Alex and Thibault are great contributors to the global Korean community. Alex, we talked about in terms of how he's an inspiration to many. And Thibault, two of his esteemed colleagues are Korean Americans. Sue Kim, who's here, is a senior partner there, and also Mark Kim, the president of Korea Finance Society. So not only does Anchorage have Goldman alums, but they have Korean alums, so they've got an excellent team. So thank you for everything that you both do for the community.
Thank you.
Next thing, go.
Thank you so much. Just for your contribution to this city and country, actually. When I was a little boy growing up in Queens, my dad, who came from Alabama, the southern part of the country, he would grow our farm in the backyard, and he'll plant a seed. And a day later, I would ask, where are the collard greens? Why haven't they grown yet? And he'd say, son, be patient. And then you'll see that little flower. Then after nurturing and watering, you'll finally see the actual vegetable come to fruition. That's where you are. When you think about this community, the Korean community, you came to the country, you started nurturing and fighting on behalf of the future. You leaned into the financial industry, and slowly you planted the seeds. And now if you look around the country, you see some of the major leaders in the financial industry come from the Korean American community. You've become giants in this city because of your commitment, your dedication, and really holding on to the things that I believe are dear. Family, public safety, small business. When I needed to find a commissioner who embodied the spirit of the Korean community that I saw when I was in Korea, I looked no further than Commissioner Kim. First Korean American to run small business services in this city. And what he's doing is paving the way for so many more. But we have real challenges. And I need you now to build into your business plan 3 things that are crucial. Number 1, those of you who have employees, every employee must be registered to vote. Your business plan must focus on who's your assembly person, your senator, your council person, your congressional person. If you have the wrong person in office, it will destroy the foundation of your business. You can no longer be detached spectators and sit on the sidelines in the full contact sport called politics. You must be engaged participants. Get on the field with me so we can win this together. We can win it together. And then you must be heard. The prerequisite to prosperity is public safety. No matter how well we do economically, if our children can't go to school safe, if your employees cannot ride our subway system safe, if you can't sit in a restaurant and enjoy your meal without someone harming you or your guests, we will never prosper as a city. That's why we're decreasing crime in this city, but I need you to add your voice in a very loud and boisterous way. We demand to be safe in the city that we love. And continue to build out the pipeline. Continue to show that this is an international city, not a local city. This is not a MetroCard city. This is a passport city. We look for global participation. We have the best product going. I say over and over again throughout the city, there are 2 types of Americans, those who live in New York and those who wish they could. We're the lucky ones. We live here. But continue to believe in this city. We recovered 99% of the jobs we lost pre-pandemic. We are outpacing the entire country. New companies are opening here every day. Embrace some of the young people, let them be part of your internship programs so they can also benefit from the growth in this city. But most importantly, we're global thinkers and global leaders. And here in this city, we're going to continue to prosper. No country on the globe a dream attached to its name but America. No German dream, no French dream, no Polish dream, but darn it, there's an American dream. And that dream is similar to the dream in Korea. Together we have the same dream. Let's make sure everyone can enjoy that dream. Thank you so much for having me.